Yeah, so I think value investing is kind of an idea that you're buying things at a discount. What exactly is a discount and what the right amount of discount is debatable, has always been debatable. So to me, I probably was pretty literal in following some of the principles of value investing from Ben Graham and then from Buffett in the early days of my career. So probably looking at least as much at book value, tangible asset value, as I was at franchise value or about growth of a business. And I've evolved for sure over time, realizing that if you're going to buy value, first of all, you got to be right about it. Then you got to think, how are you going to get the value? Is there a catalyst? What's going to cause value to be realized? So I've gone through an evolution. Margin of safety is a principle that I've not deviated from. Margin of safety is simply the idea that you want room to be wrong. A lot of things are going to happen in the world. You're not going to be able to predict all of them. So if you buy at a big enough discount, you've got that built-in margin of safety. And we construct our portfolios always focusing on downside protection, on catalysts for value realization, and other things that give us a degree of protection no matter what happens.
Is margin of safety still in your underwriting philosophy? Do you characterize it and value it and price it the way you think about it today?
Yeah, so I think the way I would describe it is we don't like add up a margin of safety and said that's a big enough margin. But what we do think about is how well protected is this investment or is this portfolio of investments? What are the elements of risk? What is going to cause? I'll ask the team sometimes when they're pitching me an idea, if we're wrong, and 3 years from now we're sitting down, or 2 years from now we're sitting down on this name and going over what went wrong, what are we going to be talking about? Trying to suss out that maybe we already know today where the biggest risks are and have we effectively valued that or taken that into account. We try to have a portfolio where we've got downside protection from hedges, from some amount of cash that we might hold that gives us some kind of buying power in the worst of moments, senior debt instruments that tend to have less downside, structural seniority in our investments or put rates in our investments, some of our private investments. So in a myriad of ways, we're protecting the downside. The downside doesn't always come, but when it's there, we tend to thrive in those moments.
Yeah. How do you think about traditional metrics? What metrics do you look at? Obviously different by different asset classes, but just give us a little bit more on valuation, how you think about valuation, how you think about fundamental value.
So our investing is based bottom up, situation by situation. So even in an expensive market, you can still find bargains. You need to verify that they are bargains. I think for me, I try to always have the balance. We like our investments, but we need to understand maybe what vintage this is likely to turn out to be. So in an era where valuations are particularly high, where back at 4, 5, 6 years when rates were held at zero for a decade, I think that we kind of in our heads knew that's not sustainable. That's never happened before. It probably will never happen again. While it's here happening, our job is still to find good investments. Are there things we can do? And so I'm always balancing. We like what we own, but if the bigger picture, such as where we are in a historic valuation framework, is extended, it's a time maybe to pull back, a time to demand a little more of your investments and maybe hold a little more cash. So we're always balancing that. But we're really driven bottom up, but we will have a layer of worry around the top down. Yeah, look, to be a value investor, sometimes I think you need a bit different wiring. So wiring that makes you want to buy in a down market where most people are scared and are selling into a down market, make you want to sell into a really strong bull market where most people are getting more excited the longer it goes on. So I think I probably have backwards or certainly differentiated wiring. Also, like, I think that value investing is such a perfect discipline for not blowing up. You know, when you think about Warren Buffett, one of the people talk about his record and his philanthropy and his annual Woodstock of capitalism. But one thing he really did amazingly is never blow up and never really go through even a rough period. And it was some combination of having a structure from the capital being permanent and having the discipline in what he's doing. And the combination of that made him relatively unique. Like, I don't think there'll ever be another Buffett, partly for the longevity, but partly because many people could never sustain that kind of return without blowing up. So I think I am patient in that. My biggest worry most of the time is that I'll never find another good idea. If I never find another good idea, life will go on. I'll have some net worth, we'll return the capital to clients, we'll go on. But there's a European value investor who said, I'd rather lose half my clients than lose half my clients' money. That's the willingness I have, that I'd rather be out of favor, I'd rather be disappointing people than doing things that I believe are not safe with their capital. So maybe I'm a good fiduciary, if at times an incompetent fiduciary.
I don't think it's incompetence. I think it's you're protecting their wealth.
Well, that's what I was going to say. People think they're hiring a manager to make them money, but partly they're hiring a manager to keep them out of trouble and maybe fight their own instincts sometimes.
Right. Do you change your mind a lot? Are you good at changing your mind? Or how do you deal with your own biases?
My biggest bias is probably around holding things too long, that waiting for them to turn out, even though we know investments don't owe you anything, it's easy to think, well, I really don't want to sell this because it might be about to work out. But at some period of time, it's time to let it go. So I push myself knowing that that's a place where I can sometimes fall short. Everybody has susceptibility to biases. I think I and my partners do a really good job of not falling for it too much. But even the best investors press too hard in certain markets. When the market's away from you, when nothing is distressed, it's hard not to press. The challenge is whether you can invest in things that won't be too bad on the day when the market turns. We know markets are going to turn, and I at least don't think we have any ability to know when they're going to turn or how bad it will be. So we try to own a portfolio that we're going to like all of the time enough and that won't get us in any real trouble.
Yeah.
So I think that the younger people on the team have only seen the markets that they've been, when you're in college, most people aren't staring at the market. So the 26, 27-year-olds just haven't seen anything really bad. So we talk about it a lot. I get other people to talk about it, not just me. So other partners or even outsiders, just to remind people that it won't always be like this. Stocks don't always trade in a narrow range. People don't always buy the dips. And truly bad things can happen in the world and not immediately fix. They can stay bad. So trying to help people just have a bit of a perspective. We also try to make it easy to be in that environment. We don't expect people to do anything on their own fully. We want them to be communicating. We want them, and this is probably one of the most important things, never to let a bad position cause them to screw up their psychology, kind of like the relief pitcher that gives up the game-winning home run in the bottom of the ninth. You want them tomorrow, not thinking about that, but thinking about how am I going to get this guy out today? I mean, in April, we were probably in a bit of a place where we were so concerned about tariffs that we're running analysis of every investment we have, what's the implication of tariffs, but it kind of makes you a little bit less willing maybe to swing the bat at the next pitch.
Yeah, I agree.
Seth Klarman is a master when it comes to valuation and margin of safety. He reminds us of something most investors forget. We often get carried away by momentum. We see a stock going up and assume it will keep climbing. That mindset traps us in a cycle of hope and luck. But money in stock market isn't made by luck. Even if someone gets lucky once, they rarely keep that money because luck has no strategy. This is where valuation hits you like a wake-up call. Before buying any stock, you must have a rough idea of what the business is actually worth. The only time valuation does not matter is when you are trading purely on news and short-term moments, basically gambling on price swings. As Buffett says, price is what you pay and value is what you get. So value investing is about buying a stock for less than what the business is truly worth. Instead of chasing hype, we focus on fundamentals, cash flows, earning power, competitive advantage, and management. A value investor does not care where the stock price goes tomorrow. They care what the business will be worth 5 or 10 years from now. Similarly, margin of safety is simply paying low price for high quality business. So even if your assumptions are slightly wrong, you don't lose money. It protects you from uncertainty, bad luck, and mistakes in valuations. Seth Klarman says, investing is about not predicting the future. It's about being prepared for it. So, investing is not about following the crowd. It's about thinking independently, valuing the business carefully, and buying only when there is a margin of safety. Momentum gives excitement, but valuation gives wealth. Don't chase price, chase value. The price eventually follows.